Well, hey there, everyone. Happy Friday, June 12th, 2026. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a warm and sunny Redmond, Washington. Spirits are high here in the Keller household. We had an awesome birthday for Mrs. Keller. A number of you mentioned that. Thanks so much for that. SpaceX IPO day, that was fascinating to watch. It's match day for the U.S. men's soccer team. We are big soccer fans in our household. My son plays club soccer, and we are big into the local Seattle Sounders and big into the U.S. with their first match tonight. So hope that goes well for the home team. I don't know if I can wear that. We actually got this for my daughter when she was a little thing for a 4th of July parade. I think I can handle the scarf for 40 minutes though. But hey, welcome to the show. My name's Dave Keller with Market Misbehavior. My goal is to help you make better decisions, to keep you informed, hopefully a little bit entertained, but ideally inspired to upgrade your own decision making. And I would say now more than ever, risk management matters. Trend following matters. Momentum matters. What you don't want to do is get complacent in a market like this. What we're going to talk about today, brief market update. We'll talk about the SpaceX IPO. Honestly, if you were thinking of the SpaceX IPO as injecting this new wave of euphoria to propel the major averages to new all-time highs, I don't know if that was the vibe I necessarily got today. Sort of like the rally we had yesterday, way more of an optimistic surge higher than what we saw today. We had a bit of a stronger open. First hour or two, pretty constructive, but from then on, pretty much sideways. The SpaceX IPO actually rotated lower after that big surge higher. Still finished up quite a bit above the IPO price, but did not just go straight up like a rocket, kind of pulled back a little bit going into the close. We'll check on that chart along with some others here as we debrief on the market today. And then I've hand selected 5 or 6 awesome questions from all of you over the last week to dig into a little bit deeper. That's what we like to do on Friday. And I'm glad that you're here to celebrate that this mailbag episode with me. As a reminder, we're live streaming on Facebook, LinkedIn, YouTube, and X. Those of you tuning in live, thank you so much. Luckily, right between World Cup games, and while we're all being honest with each other, I was a couple minutes late because I wanted to watch the end of Canada and Bosnia-Herzegovina. Ended up being a draw, but it was a pretty good match with some really good moments. Apologies for that, but hey, it's World Cup time. All right, let's get to the major averages and what happened. So the S&P finishing higher 0.5%, 74.31 and change. The Dow propelling above 51,000, which is great to see. The NASDAQ composite notably lagged behind the S&P and the Dow, but still finished about 1/3% higher. Best performing index on the front page, the Dow Utilities Index, finishing near the highs of the day, up 1%. Volatility lightening up, down almost 2 points today. VIX sort of generally drifted down in the afternoon, got below 18 at the close. So VIX below 20 basically means not much to worry about in terms of volatility. VIX above 20 is where we want to be concerned about excessive movements, because that usually happens way more often in bear markets than in bull markets. So the VIX kind of drifting lower to finish the week, one of the better signs that we'll see. So while I can come up with a lot of reasons why maybe the market could not or should not go up, the fact remains we're not too far off of all-time highs. The fact remains we really have held major short-term support, and the fact remains the volatility remains low. Those are all good things for stocks. Checking in elsewhere, rates kind of drifting higher today as bonds sold off a bit. The dollar was essentially flat. In the commodity space, gold and silver getting a decent bounce, although I would say gold and silver still not great, particularly gold that is languishing below its 200-day moving average. Crude oil prices dropping pretty good today on the latest of many, many headlines and posts regarding the fact that a peace deal is just around the corner in the Middle East. So still waiting for that final confirmation, but the headline's enough to push crude oil and Brent crude oil futures down about 4% for the day today. Cryptocurrencies all slightly in the red, but not by much. It was really more of a choppy day in crypto land. Bitcoin around 63,500. Hey, 9 out of the 11 S&P sectors finished in the green today, and that's pretty good. The materials sector at the top of the list up 1.9%. Financials and utilities both up over 1% for the day. You have to go down to the 5th one on the list to get to technology. And that, as you probably know, is SpaceX's sector. And that, as you probably know, is 40% of the S&P 500, and that, as you'll see here, not near the top of the list. Two of the S&P sectors in the red: communication services down 0.4%, and healthcare down 0.2%. Looking elsewhere, hey, on the market factors widget here on stock charts, just worth noting that yet again, small caps outperforming large caps. So as much as so many have been focused, and I certainly have been at times, on the mega cap growth trade and what those are doing, let's keep in mind that that small caps have been the best place to be year to date. They've been the best place to be in the last month, and they remain the best place to be today. So in my own portfolio, I'm way more tilted small than large in terms of an ETF play, and it's because of those moves. All right, looking at the Magnificent Seven and friends, as promised, SpaceX got a place at the table here. SpaceX, of course, 1 day percent move up 19%. That's essentially coming out of the IPO price and open for trading. It did get up into the 170s. So it was up about 25, almost 30% at one point. I think it peaked around 28% above the IPO price. Something around there, might not be exactly that, but it was up a lot more. The afternoon was sort of a lightening up. And, you know, again, I'm a big fan of not reading too much into an IPO, date. I mean, there's going to be obviously a lot of pent up demand. The IPO is the largest in history. It was oversubscribed. So a lot of retail traders today at the open was the first opportunity to get in. Obviously, a lot of them try to jump on that opportunity and push the price aggressively higher. By the close, we kind of come off a bit. So what's interesting about a day like today is I would say a bunch of people that bought in the morning are probably currently underwater on the SpaceX IPO on day one of trading. So welcome to the challenges of trading an IPO right after it's released. In the days and weeks to come, that's where we'll start to gather enough data to really make a technical evaluation on SpaceX. What you have to remember is, as a chart guy, a chart's only as good as the data, and you can't use half a day of trading to make any meaningful long-term conclusions about SpaceX. What we can start to do is start to think about the range. What was the IPO price? Where did we open? Where did we close today? What sort of trading range do we have? Now we can start to gather some data about, do we break above that range? Do we just fill in that range? Do we start, getting down to the IPO price, which a lot of IPOs have had an initial surge higher and then they quickly go below the IPO price. So something to pay attention to for sure. I would say elsewhere, the Musk trade appearing to be pretty good today. Tesla up 1.8% as well. On the downside, Apple, Amazon, Broadcom, Meta all finished down today. So again, I mean, if you're looking for the SpaceX IPO to be the next big thing that's causing further excitement about AI, I didn't get that necessarily from today's session, but that's just one day. Let's see what happens starting next week. So the S&P bouncing on Thursday and Friday, and that is going to save what looked to be a really, really painful week. And 4 straight days of closing below the open ended on Wednesday, Thursday, and Friday. Now, nice bounce higher. This is what I call the chart, just looking at some major metrics. The Advance-Decline line on the New York Stock Exchange, I mean, almost making a new all-time high today. And so I would say the breadth data that we've been observing, right, below all-time highs, right, as we've seen in a number of cases, but starting to improve here. And the small cap Advance-Decline line is the only one of those major ones that actually has made a new all-time high in June. But it looks like the NYSE's AD line very, very close to doing so. We're holding the 50% level on some of those breadth indicators like the bullish percent index, like stocks above their 50-day. And I think that's pretty encouraging. Offense over defense, really more neutral than anything. All right, that's it for a recap. We're going to dig more into some of the longer-term charts and their implications for our premium members. So premium members, look for our weekly flight plan over the weekend. We usually do that first thing Sunday morning when things are quiet here in the Keller household, and I can spend some time with some coffee and some chill music, reviewing a bunch of charts and sharing some insights. It is not too late to become a premium member. Go to marketmisbehavior.com/premium for more info and all the great benefits our premium members enjoy. As a reminder, these questions all came from people like you watching the show and just asking questions off the top of their mind as we go along. So please use our chat anytime during the live stream. Please use the comments section on our YouTube channel. We'd love to hear from you and hopefully answer your question in our next mailbag episode. Analysts at Merrill Lynch used to say, watch the IPO market to determine if you're close to a market top. What about a monster deal like the Musk IPO? Well, number one, I love that we're calling it the Musk IPO because that really, I mean, it's so funny. If you, I don't know if any of you have watched the Apple TV show. Oh my gosh, I was going to say From the Earth for All Mankind. Awesome sort of alternate history. So it starts in the 1960s. The space race completely changes away from what happened in reality, and every season is a different kind of decade. And I don't want to spoil anything beyond that, but it was awesome, and I've enjoyed it quite a bit. But at one point, there is a Musk-like person who is so hell bent on colonizing Mars that a lot of crazy things happen. And that was top of my mind this week as we're hearing the SpaceX IPO and thinking about all of those implications. Having said that, right, watch the IPO market 100%, right? And I would say that is a common strategy thinking about ETF issuance, right? And I've seen that with ETFs. So, and we saw that with funds at large buy side firms. Let me talk about each of those separately. With ETFs, what you have to remember is an ETF or an IPO, goes public when there's enough excitement to bid the stock up a lot, right? That's the whole point of going public, is gathering, obviously raising a bunch of capital, but ideally, insiders and shareholders benefit greatly from the, future growth. That's not just going into the IPO, but coming out of the IPO, right? That's the ideal situation. You raise a ton of money and then you generate a lot of money for shareholders and, for yourselves as employees and managers of the company. But that's sort of an interesting chicken and the egg situation, because the only way an IPO can raise a ton of capital is if people are super excited about the theme, which means the company's probably done a lot already, and it probably has grown to the point where an IPO starts to make sense. And so the question with all of these IPOs, with SpaceX, with Anthropic, with OpenAI, are these going to be marking sort of the topping phase of this AI trade when euphoria is at such a fever pitch that these IPOs are oversubscribed? That is very much a potential future path that I think is worth thinking about. And particularly thinking about what warning signs will tell us that's what's playing out. And I think the post IPO trading in SpaceX could be one of those interesting data points to help us understand that. We've seen that with ETFs, because ETFs will finally be released when there's enough excitement to boost when there's a lot of people that want to have exposure to that particular thing. And so when the ETF finally is released, that's often the end of the move. You don't release an ETF in AI if AI is getting absolutely clobbered, because no one would buy it. So that's why that tends to work. It's kind of similar to when a major publication, back when people used to read magazines, we would look at The Economist and look at Barron's and look at Time and Newsweek, when those were actual periodicals that people would read every week. And when they would pick up on a financial topic, it was usually the end of that move. And there's a lot of great examples we had featured at the Fidelity chart room celebrating some of those. So yeah, so I think that is a very real possibility that these IPOs are coming out in like the 8th or 9th inning versus the second or third inning. I mean, will a company like SpaceX be, stronger and better and successful 10 years from now? I would hazard a guess to say absolutely. I don't think that's a bad long-term play. And the good news is, if you own any passive index fund or ETF, you own a bunch of SpaceX now, right, through that ETF. So that's good. Most of us participated in the SpaceX IPO, whether or not you directly subscribed. I personally did not. But I knew I would get exposure through a bunch of ETFs that I probably already own. And so that's kind of the way that I'm thinking of it. The good news is, I don't think we have to predict the future and know whether SpaceX is going to go up from here. We just have to watch the chart. In my interview with Dave Lundgren, which hopefully will be out to you guys very soon, we talked specifically about trying to predict the future versus trying to follow the trends. And the latter is way more easy to repeat and do consistently, because you just have to follow the evidence. All right, next question. The late Art Cashin mentioned planetary cycles. I don't get a lot of questions about astrofinance, and this might be a first. I don't remember. I haven't gotten a lot of these, so I appreciate you asking about this. And poked around the rabbit hole. Did you ever stumble into Bradley and the planetary alignment cycles and effects on markets? I have a lot of thoughts on this, by the way. So Art Cashin, obviously a legendary investor. For many, he represented. He was the NYSE in human form. Just a great representative of the history and prestige of that trading floor. So sad when he departed this earth, but so many learned a lot from him and what he was willing to share. So I think we're all thankful for that. I'd not caught Art Cashin talking about planetary cycles. So I don't know if there's an interview or a particular place where he talked about it, and I probably just missed it. But I do know Bradley dates are something that are referred to pretty randomly, I guess, in the technical analysis community. There's an astrologist back in the 1940s named, I'm thinking it's Milton Bradley, and that's not it. Donald Bradley, I'm gonna say was his name. I'm 80% sure it was Donald Bradley. Was a astrologist, and he basically in the 1940s wrote this book, and he projected major kind of turning points, major cycles, decades in the future. And there are a number of people that have done things like that. Like the Kondratiev wave comes to mind, these things where you're projecting kind of seasons and cycles way out in the future. Gann has a table of data that some of my guests on the podcast have mentioned before. But Bradley in particular is looking at planetary alignment. It's literally this idea of looking at where Jupiter and Mercury and all the planets are relative to one another. And you can look at the common, and I'm summarizing here, you can look at their positions relative to the Earth or relative to the sun and sort of project major turning points. Now that's based on this kind of more esoteric practice called financial astrology, implying that the markets have any relationship to planetary positions. That is a subject of great debate and skepticism. And I would say for me, having spent my career trying to legitimize technical analysis and demonstrate how money managers and risk managers and advisors can use charts to follow trends and manage risk. For me, planetary movements did not fit into that general approach that I'm trying to explain to people. So I've usually avoided some of those more esoteric parts of the what's probably still considered in the technical analysis umbrella. And things like the CMT exam, which is the professional level exam, doesn't really include ththings like this. They're considered more kind of off to the side. And things, again, that some believe in deeply and others are deeply skeptical of. So having said all of that, I've looked at Bradley dates before. If you ask me what the Bradley dates are for 2026, I couldn't tell you. I actually used to print them out every year between you and I and put them on a wall in my office back in my Bloomberg and Fidelity days, just to kind of track where they were. But as with any cycles, for me, trend is way more important than cycle, right? So if a cycle date is due, if today's a cycle day, but the chart is telling me one thing, I don't care what the cycle is telling me, the chart is more important. So I guess I've learned to lean more into trends as opposed to predicting potential turns ahead of time. And maybe if I was a swing trader and betting more on a short-term time frame, I might find them more valuable. Having said all that, there are a bunch of books. If you want to learn more about, there are a bunch of people that have written on it. Connie Brown, the late Connie Brown, got into that a lot and wrote a lot more about that later in her career. Larry Pesavento has written some books on planetary cycles that I've reviewed and evaluated at times. I'll leave you this one thing, and then I'll get to the next question. There is one area of research that I find absolutely fascinating, and that's on lunar cycles and related to the markets. And there is documented academic research that shows that people behave differently during different moon phases. For whatever reasons, the pull of the moon, the magnetic field, whatever it is, that is actually, if you Google people acting differently during different moon phases, that is actually well documented. It is also documented that people have, and their irrational decision making affects stock prices, right? People are irrational, and we get nervous, and we get excited, and we get panicked. The whole behavioral finance, discipline is built around people acting irrationally. So if we've proven that moon phases cause people to act weird, and if we've documented that people acting weird causes changes in the stock market, is it that much of a connection to say lunar phases and the stock market have a relationship? I don't think so. Honestly, have I seen a lot of research that's directly connected those two in a meaningful way? I have not. maybe it's out there and it's come out since I've looked at it last. But that would be my general take. So compared to like the planetary movements, I think lunar cycles makes a lot of things. But yeah, there are plenty of people. Larry Williams, someone had mentioned, also does some work with planetary cycles. And there's actually an organization called the Foundation for the Study of Cycles that actually thinks about those things among other things. That's another good place to look if you're interested. Generally not a part of my approach, but listen, I learned a long time ago, have an open mind, and that means things that sound weird and look weird often have led me into some interesting thought process and discoveries, and I'm thankful for that. All right, next question. Could you please explain the difference between, and thanks for the next person asking a very concrete question after two kind of soft and fluffy ones, between $NYAD, the cumulative Advance-Decline line, which came to a close to a new high on May 28th, versus AD line NYC, which did not come close to an all-time high. I bet we could figure that out. So these are tickers on stock charts. So many of you I know use the stock charts platform. That's great. If you don't, that's fine too. I mean, there are plenty of great charting platforms out there. Stock charts is one that I use often, but you've probably known if you followed my work for a while. I use other ones as well, like Koifin and EPS Momentum, and Optima is one that I've used for many, many years. And there are others that I don't use anymore, but I have, like Bloomberg and Updata and others. But having good charting platforms for me is absolutely essential. But here's the issue. Breadth data is not standardized. So every platform treats breadth data differently. Every platform can calculate breadth data differently. If there's one thing that's very unfortunate about the financial markets for traders is that breadth data is not standardized. So the tickers, the methodologies, when you compare one thing on a platform versus that same, what looks like the same thing on another platform, they're often drastically different. And the reason is because there's not a big conference once a year where all the charting platforms get together and agree on how to do stuff. Everyone does it in a way that makes sense to them and their developers and whoever's driving development, and it just leads to some inconsistency. So my comment first off is just make sure that you understand the data you're looking at, right? And that's important. So on stock charts, you're looking $NYAD, which is advancers minus decliners every day. And then you said the cumulative ones, you can change that to what's called a cumulative chart. And so this is basically keeping a running total of the positive and negative values and looking at a cumulative version. This is called a cumulative Advance-Decline line. Pretty common, to do something like this and look at the performance. Now, the other thing you're looking at is exclamation points, ADL. Yeah, this is the Advance-Decline line. This actually already is in a cumulative version, so you don't have to do that. And I'll make this a line chart so we can see it a little easier, or at least make a comparison. Right. So your question is, why don't the two of these look the same? And forget about the stuff at the bottom. Just focus on the data point. You had said right here, right? The AD, the first one, advancers decliners, basically tested a new all-time high at the end of May, and this one did not. So okay, so one letter makes a huge difference, and that's your problem. So this is looking at common stocks only. So what you have to remember is on the New York Stock Exchange, it's mostly common stocks, right? Like IBM, but then there's also closed-end funds. There's other things that are listed on the NYSE but are not common stocks. So there's two different breadth indicators. Exclamation point AD line NYA is going to be everything, and that should match pretty much. It looks pretty good to me. It's different because of the bottom series, but if you look, like these two are identical in the top, and that's because they're showing the same data, right? So when you change it to this, you're eliminating all the closed-end funds and stuff like that, and looking at common stocks only. Which one is the right one? I mean, that's another one that is a source of great debate at a CMT conference. This is the kind of argument we would get in over a beverage or five, would be which of these is better, and people have very strong feelings about one or the other. If I remember right, Tom McClellan, who's big into breadth data, swears by the cumulative, the total advancers decliners, and including some of that other stuff. Others like who was it? I'm blanking on your name, and I am so sorry. guy who was at Lowry Research for a number of years used to swear that you only use the common stock only one. And I'm so sorry, I'm blanking on his name right about now, but it's just not, it'll hit me on question number 5. I'll remember his name again. Paul Desmond. That was you, the late Paul Desmond would swear by common stock only. So, and those are two very knowledgeable, successful technical analysts with very different opinions. So what do I use? I generally use the common stock only advanced decline line. That's the one that I feature on my my main chart. The one that I use is this one. And again, I can only explain to you the different thoughts on this and explain to you why I use the one that I do. Other people will probably greatly disagree with me, and that's fine. This is the NYSE common stock only advanced decline line. And then I do the same AD line for the S&P mid cap, and S&P small cap. Those are the 4 lines that I review every single day. And this top one is the one that you were asking about, which did almost, I mean, just barely try to make a new all-time high here today on Friday, June 12th. All right, we'll continue on in a minute. I did want to give a shout out to one of our partners, Seeking Alpha. They're actually doing their summer sale, just started this week. For new members, you get 25% off if you go to marketmisbehavior.com/SA bundle. There's a bundle that they're offering right now where you actually get their premium membership, which means you get access to their quant model, all of the research, all of the portfolio tools, which I've reviewed, which I think are pretty well designed and illustrated on the website. But you also access alpha picks, and they're actually just going to announce their second alpha pick for June, coming up on Monday, June 15th. So if you sign up this weekend, you can check out that webcast coming up this Monday. You can find more information about what's included in their premium platform, also alpha picks, where they hand select stocks using their quant methodology at marketmisbehavior.com/SA bundle for Seeking Alpha bundle. Again, for new members, you get 25% off a new account, and that bundle is a pretty good time to get a bundle like that. So thanks again, my friends at Seeking Alpha, for supporting Market Misbehavior. All right. I tell you what, I'm getting a lot of questions right now, kind of high-level questions about IPOs and market structure and things. And hey, I am happy to point you in the right direction and answer questions all the time. Can you tell us how rebalancing of index funds happens when the quarterly index rebalance happens? NASDAQ will be rebalanced on June 22nd. So will QQQ rebalance on the same date? Yeah, so what's happening is, right, you have this index rebalance, and then everyone has to kind of reshuffle their benchmark, right? So the QQQ will have to rebalance. All of the, anyone else that runs an index fund that is pegged off of some index that rebalances, they all have to change it as well. So what happened, and I'm giving you the short version, I'm giving you the summary notes on the executive summary on what happens. But basically, the index provider, because you have to remember the index, like the NASDAQ, announces changes to the index, but they don't actually manage any of those index funds. It's some index provider like iShares or JP Morgan or whoever, whatever ETF ProShares or whatever ETF provider it is, has to then adjust their holdings to match it. So what happens is they kind of announce ahead of time, here's the rebalance and here's what's going to be rebalanced. And then ETF providers, fund managers have like a window of time where they can rebalance their own funds to kind of get to those target weights. And their goal is to hit the target weight at the date of the official rebalance. So for something like the QQQ, it's a pretty efficient process, and they're pretty good at getting that and hitting that mark very, very well. For like a smaller index fund provider, that's something they really have to figure out. In reality, I would say there's a lot of trades that happen, which means you can kind of assume which, when you know what stocks are going to be added and which stocks are going to be removed, you can know what flows are probably going to be expected in that window before the rebalance date, because that people are going to try to get ahead of it a little bit. That's why sometimes there's speculation about when a stock might be added to an index, because they know that would generate some inflows, or the opposite if they think a company is going to be removed from the index. It's not necessarily just buying individual stocks. They certainly could use swaps or some sort of derivative to try to get them similar exposure while they're trying to accumulate a meaningful position. So there's a lot of things that can happen between those periods, but that's why you usually get a run up in stocks going into that rebalance date, because fund managers and index providers are starting to get ahead of it, and they know they have a window of time to get to it. And the goal is, or the idea is, you need to be rebalanced by June 22nd at the close, So usually June 22nd to the close is when you get like a big surge of orders to kind of do that final rebalance. So that's something to think about in terms of dates. And I know at big money managers, we would often review once you had the moment you had the announcement, you would start to review that to think about how your benchmark was going to change. Even if you didn't own some of those names, that would change your active bet. That would change like what kind of bet you're making. If you do or do not own those stocks, it was something we would analyze very, very deeply. All right, next question. You seem to use many breadth measures, AD lines, new highs, new lows, percent above the 50-day, bullish percent index, etc. Any one or two that you have found to be the most effective and most predictive? Yeah, that's a really good question. And you're right. I actually do quite a few. And the ones that I've found interesting, or the ones that I found meaningful enough to watch all the time, this is the main chart list that I review. And so it's the cumulative advanced decline lines, it's the McClellan oscillator, it's new highs and new lows, it's percent above the 50 and 200 day, and it's the bullish percent indexes. Those are like the 5 sets of breadth indicators that I follow very, very closely. There are other breadth indicators that I just don't follow as closely, but that's the list that's most important to me. I mean, what's most important? I think the advanced decline lines themselves are incredibly meaningful. And again, I'm going back to like formative years as an analyst, as a technical analyst, and learning about breadth. I was fortunate to have Phil Roth in New York, and I would go to New York meetings and eventually talked with him about joining the board of the MTA at the time, and Phil was part of that. He was, if I remember, I think he was president either right when I joined the CMT or when I got my CMT. I forget what it was, but Phil was a president around that time as well. And I heard him present a bunch of times, and he was big into breadth. And I remember one of Phil Roth's presentations was the first time when I really was like, breadth is really like, I understand why just looking at the chart of the S&P, you're not getting the whole picture, and why looking at these other indicators really helps you understand the interplay of all the stocks that make up those benchmarks. It made a lot of sense to me. So I'm very appreciative to Phil for inspiring me to learn more about breadth, and it's eventually become a really important part of my process. The advanced decline lines are super important. I pay less attention to the daily advanced decline line reading, but more about the cumulative advanced declines and what they're doing. The second thing I would say, the McClellan oscillator, in terms of a short-term breadth indicator, this is the one that I follow the most closely, and it's derived from the daily advanced decline reading, but it's a great way of just thinking about short-term shifts in breadth. And then I would say the third line that I would look at all the time is this one: stocks above their 200-day, stocks above their 50-day. That has served me very well in terms of recognizing when the market is not being validated by confirmation in the form of stocks going above their moving averages. Tony Dwyer, who was at a number of firms, but Canaccord Genuity for many, many years, and then ran his own research, the Dwyer strategy, I believe he called it, would look at shorter term ones like 10-day stocks above their 10-day moving average, which is another good kind of short-term indicator to track breadth. Great questions, by the way. These are awesome questions today. All right, final question. Then we will call it a weekend. We will go and watch our U.S. men's soccer team ideally beat Paraguay and start off with a couple points to begin this group stage. Comcast has a better dividend in the telecom space than Verizon and is massively undervalued. Could be ready for a comeback. Let's evaluate it, shall we? So first, I'm not going to disagree, but I'm going to evaluate your first, position, which is Comcast has a better dividend in the telecom space than Verizon and is massively undervalued. So you're absolutely right on the dividend yield, right? I mean, they're both pretty extreme, though, right? So if you look at the forward yield, so this is an estimated yield, basically assuming similar dividend payout. What would the next 12 months look like if you bought it at the current price? And it's almost 6% for Verizon, and it's 6.7% for Comcast. The difference between those two, they both pay a decent dividend. It's that Verizon's up for the year in a pretty big way from like 39 to 48, and Comcast is down year to date from 20, we'll call it 27, down a little bit to 24. And so Comcast is going down and Verizon's going up. So the dividend yield will get better and better as the stock price goes down, because it's the dividends, the forward 12 months estimated dividend divided by the current stock price. So if the stock price goes down, that number starts going up. So they're both, I would say they are both way above average in terms of dividends. I don't know if I would say Comcast is a way better dividend. I think they're both pretty healthy and both way above average versus the S&P for sure, to be clear. Now, massively undervalued, I would say when you talk about something being massively undervalued before looking at the chart, I know the chart probably looks like absolute crap, because if you get all excited about low valuations, the only way that's happening is if the stock price is going down a lot. And so my challenge with the chart like Comcast is, are you really buying at the low, or are you just buying at one of the many lows as the stock continues to go down? So, let's talk about the valuation. Again, not about the fundamental valuation. I think you could, pretty low relative to earnings and probably most other metrics. And that's because the price is down so much. And so the numerator in those valuations is very, very low. But let's talk about the chart at its merits. I would say at an initial glance, it looks like Comcast is kind of checking the lows from the fourth quarter of last year, which is kind of interesting. And if you look at the weekly chart, we're actually testing the lows from 2022. So on the surface, it actually looks pretty interesting. Here's the problem. We're looking at this right now on a total return basis. And if you take the dividend impact out, you can see that Comcast is actually in an aggressive downtrend right about now. So even though on a price basis, it looks like we're testing the lows, on stock charts, it defaults to including dividend adjustments, which means anytime the stock pays a dividend, you adjust all the historical data. And in a downtrend like this, what happens is the chart looks a lot better than it actually is, because those dividend adjustments are basically lowering the old prices to adjust to the new price value. If you take the dividend adjustment out, you can see the stock's making a consistent pattern of lower lows and lower highs. So for me, this is a classic falling knife chart at this point. For me, not enough to get excited about. What would I get excited about? For me, on a chart like this, it's been going down a ton. The weekly MACD and getting a buy signal is usually the game. And you can see some examples like here, May of 2020, that is, not at the low, a little bit after the low, but after the price has rallied enough. Here at the end of October of 2022, after the low, but a little bit later, but when the price is actually recovered. And you've seen that on a shorter basis here, like mid 2024, here in April of 2025, here in December. I don't see one of those yet. So in a chart that's going down a lot, for me being, more of a trend follower, I need to wait until the trend has turned enough that I would say now this is a new accumulation phase. Weekly MACD or weekly PPO is one of those tricks that I've used to try to be patient and wait for that upturn to actually emerge. Folks, that'll do it. Thanks so much for joining me here today on SpaceX IPO launch day, and also first major day of the World Cup here, and the first U.S. match. Go USA! Hope we do well. We'll be watching, and I hope you guys all enjoy the weekend of soccer as well. For those who celebrate, otherwise have a great, joyful, restful weekend. Enjoy it. We'll be back on Monday with Chart This with Dave Keller. And in the meantime, remember, it's always a good time to own good charts. Take care, folks.